The crash happened. You watched it. Maybe you felt it directly in your portfolio. Gold plunging from all-time highs, silver collapsing even faster, billions in value evaporating in what felt like moments. Investors who were celebrating weeks ago suddenly questioning everything. But here's what nobody's asking. What if this crash wasn't the end of something? What if it was the beginning? Because I've spent the last month studying every major precious metals crash since 1970. Not just the crashes themselves, but what happened afterward, the patterns that emerged, the moves that followed. And what I found might surprise you. Every single major precious metals rally in modern history was preceded by exactly what we just witnessed. A violent, unexpected crash that flushed out weak hands, reset positioning, and created the conditions for the next major move. Not sometimes, every time. 1976 crash preceded the run to $850 gold. The 2008 crash preceded the run to $1,900. The 2013 crash preceded years of accumulation that eventually launched gold above $2,000. The 2020 COVID crash preceded new all-time highs within months. This isn't hopium, this isn't wishful thinking, this is documented price history that you can verify on any charting platform. But here's the critical question. Are the conditions in place right now for history to repeat? Is this crash setting up the next major move? Or is this time genuinely different? By the end of this video, you'll understand exactly what typically happens after precious metals crashes, what conditions are required for major rallies, whether those conditions exist today, and how to position yourself regardless of which scenario unfolds. Because the next move in gold and silver could be significant, in either direction, and being prepared for both possibilities is how you survive and potentially thrive in volatile markets. Welcome to the silent economy. Let's examine what happens after the crash. To understand what might happen next, you need to understand what crashes actually accomplish in market structure terms. Crashes aren't just random violence. They serve a mechanical function. Think of precious metals markets like a rubber band. During bullish phases, speculative positioning stretches that band further and further. Leveraged traders pile in. Momentum builds. The band stretches tighter. Eventually, something snaps. The crash is the band releasing that stored tension, violently. But here's what matters. After the snap, the band returns to a neutral position. The excessive speculation is cleared. Weak hands are flushed out. Leveraged positions are liquidated. And from that reset point, a new move can begin. This is why major rallies often follow major crashes. The crash creates the conditions necessary for a sustainable advance. Now, let me give you the framework for what typically happens after a precious metals crash. Phase 1. The capitulation bottom. The final wave of selling exhausts itself. Volume spikes as the last leveraged longs are liquidated. Sentiment reaches extreme pessimism. Media coverage turns bearish. Retail investors swear off precious metals forever. This phase marks the actual bottom, though it's only identifiable with certainty in hindsight. Phase 2. The accumulation period. Smart money begins accumulating quietly. Central banks continue or increase purchases. Long-term investors add to positions, but prices may remain flat or continue drifting lower. This phase can last weeks to months. During this period, positioning data begins shifting. Commercial net short positions decrease. Speculative interest remains low. The market heals beneath the surface. Phase 3. The foundation build prices stabilize. Higher lows begin forming. Selling pressure diminishes because everyone who wanted to sell has already sold. A base develops from which the next move can launch. Phase 4. The new advance. Eventually, a catalyst emerges. Fundamental conditions reassert themselves. New buyers enter. Prices begin climbing from the reset level. This framework has played out after every major crash I've studied. The timing varies, the magnitude varies, but the sequence is remarkably consistent. Now, there are 4 conditions that historically must be present for major post-crash rallies to develop. Let me walk you through each one. Condition 1. Positioning reset. Speculative long positions must be substantially reduced from their pre-crash extremes. This is measurable in Commitment of Traders data. Condition 2. Fundamental drivers intact. The underlying reasons people buy precious metals must still be present. debt levels, monetary policy, currency concerns, geopolitical tensions. Condition 3. Physical demand sustained. Central bank purchasing, jewelry demand, industrial consumption, retail accumulation must continue despite paper price weakness. Condition 4. Monetary conditions. Supportive interest rates, real yields, dollar dynamics, and central bank policy must be favorable or trending favorable. Let me show you how these conditions played out in previous post-crash rallies. Example 1. The 1976 crash and what followed. By August 1976, gold had crashed from $200 to $103, a 47% collapse in less than 2 years. After the explosive move from $35 following Nixon closing the gold window, many believed the gold story was over. Headlines declared gold a failed investment. Institutional interest evaporated. Retail investors who had bought the top sold in disgust. Sentiment was devastated. Let's check the 4 conditions. Positioning reset? Absolutely. Speculative interest had collapsed along with price. The speculative excess of 1974-75 was completely unwound. Fundamental drivers. Intact? Yes. Inflation was accelerating. Government spending was rising. Monetary policy remained loose. Nothing had changed about why gold should be valued. Physical demand? Sustained. Central banks held their reserves. Jewelry demand continued. The physical market remained active despite paper price weakness. Monetary conditions? Supportive. Real interest rates were negative. Inflation was outpacing nominal yields. The dollar was under pressure. All 4 conditions present. What happened next? From that $103 low in 1976, gold began a 4-year advance that culminated at $850 in January 1980, an 8x return from the crash bottom. One of the greatest moves in commodity history. Those who bought the crash were rewarded enormously. Those who sold the crash missed one of the greatest rallies ever recorded. Example 2. The 2008 crash and what followed. October 2008. The global financial system was in freefall. Lehman Brothers had collapsed. Credit markets were freezing. Panic was everywhere. Gold dropped from $1,000 to $680, a 32% crash. Silver collapsed from $21 to under $9, a 57% devastation. Wait, precious metals are supposed to be safe havens. Why did they crash during a financial crisis? Liquidity crisis. Forced selling across all asset classes to meet margin calls and raise cash. Everything sold together. But let's check the 4 conditions after the crash. Positioning reset, complete. Speculative longs were obliterated. The COTI data showed managed money positioning at multi-year lows. Fundamental drivers intact? More than intact. They had intensified dramatically. The Fed was launching quantitative easing. Money printing was about to begin at unprecedented scale. The fundamental case for precious metals had strengthened, not weakened. Physical demand? Surging. Retail coin demand exploded. Central banks shifted from net sellers to net buyers. Physical shortages emerged despite falling paper prices. Monetary conditions? Extremely supportive. Interest rates were cut to 0. Real yields went deeply negative. The dollar was being actively devalued through QE. All 4 conditions present, strongly. What happened next? From the October 2008 lows, gold rallied to $1,921 by September 2011. Silver exploded from $9 to nearly $50. Gold nearly tripled. Silver rose 5x. The 2008 crash set up one of the greatest precious metals rallies in modern history. The crash was the opportunity, not the end. Example 3. The 2013 crash and what followed. April 2013. Gold flash crashed from $1,550 to $1,320 in 48 hours, the most violent decline in 30 years. Silver fell proportionally. This crash was different. It wasn't a liquidity crisis. It was concentrated selling into the paper market. And it continued. Gold eventually hit $1,050 by late 2015, a 45% decline from the 2011 highs. Let's check the conditions in 2013. Positioning reset? Yes. Speculative longs were crushed. Fundamental drivers? Mixed. The Fed was discussing tapering QE. Interest rate hike expectations were building. Some fundamental drivers were turning less supportive. Physical demand? Enormous. Chinese and Indian buying surged. Coin sales hit records. Physical demand was absorbing everything available despite paper price weakness. Monetary conditions? Shifting. The Fed was moving toward tightening. Real yields were rising. Dollar was strengthening. Two conditions strongly present. Two conditions shifting unfavorably. What happened next? The immediate rally didn't materialize. Instead, gold spent nearly 3 years building a base between $1,050 and $1,350. This was Phase 2 and Phase 3 of the framework, extended accumulation and foundation building. But eventually, by 2019, gold broke out. And by 2020, it hit new all-time highs above $2,000. The 2013 crash did set up a major move. It just took longer because monetary conditions weren't immediately supportive. The rally required patience. Example 4. The March 2020 crash and what followed March 2020. COVID-19 panic. Everything crashed together. Gold fell from $1,680 to $1,450. Silver collapsed from $18 to under $12. Another liquidity crisis forcing selling across all assets. Let's check the conditions immediately after. Positioning reset? Complete. Leveraged positions were liquidated across the board. Fundamental drivers? Massively strengthened. Governments announced unlimited stimulus. Money printing accelerated dramatically. Debt levels exploded higher. The fundamental case for precious metals had never been stronger. Physical demand? Exploded. Retail investors scrambled to buy physical metal. Premiums soared. Dealers ran out of inventory. Central bank buying continued. Monetary conditions? Extremely supportive. Rates cut to zero. Unlimited QE announced. Real yields deeply negative. Dollar weakening as money supply exploded. All four conditions present, emphatically. What happened next? From the March 2020 lows, gold hit new all-time highs above $275 by August 2020. A 43% rally in 5 months. Silver more than doubled from its crash low. The crash was the setup. The rally was historic. 4 crashes, 4 eventual rallies. The pattern is consistent. So the critical question: are the 4 conditions for a major rally present right now? Let me walk through each one based on currently available data. Condition 1. Positioning reset. The Commitment of Traders data shows that managed money net long positions declined significantly during this crash. Speculative excess has been reduced, not eliminated entirely, but meaningfully unwound. Commercial short positions have also decreased, indicating that the commercial traders who were positioned short during the speculative buildup have covered at least some of their positions. Is this a complete reset to the extremes we saw after 2008 or 2020? Not entirely, but meaningful progress toward reset has occurred. Condition 1, partially met. Condition 2, fundamental drivers U.S. government debt now exceeds $36 trillion and continues growing. Global debt levels are at all-time highs. Central banks have demonstrated they will print money during any significant crisis. Inflation, while moderated from 2022 peaks, remains elevated compared to pre-pandemic levels. De-dollarization discussions continue globally. Geopolitical tensions remain elevated across multiple regions. Has anything fundamentally changed about the reasons investors hold precious metals? The debt hasn't decreased. The monetary system hasn't stabilized. The long-term structural concerns remain. Condition 2. Met. The fundamental drivers that supported previous rallies remain in place. Condition 3. Physical demand. Central bank gold purchases have been running at record pace for consecutive years. China, Russia, India, Turkey, and numerous other nations continue accumulating. According to the World Gold Council, central bank buying has exceeded 1,000 tons annually in recent years. This represents structural demand that doesn't respond to short-term price movements. Retail physical demand remains robust. Coin and bar sales continue at healthy levels. Industrial silver demand continues growing, particularly for solar panels and electronics. Condition 3. Met. Physical demand fundamentals remain strong. Condition 4. Monetary conditions. This is where it gets more complex. Interest rates remain elevated compared to the zero-rate era of 2009-2021. Real yields are positive, which historically creates headwinds for non-yielding assets like gold. However, rate cut expectations remain embedded in market pricing. Central banks have signaled that the tightening cycle is mature. The next major move in rates is likely lower, not higher. The US dollar has strengthened recently, creating short-term pressure. But structurally, with massive debt levels requiring eventual monetization, long-term dollar weakness seems probable to many analysts. Condition 4. Mixed. Current conditions are not as supportive as 2008 or 2020, but are better than 2013 and trending potentially more favorable. Overall assessment: 3 out of 4 conditions are met or partially met. Monetary conditions are the wild card. This is similar to the 2013 setup, which required patience but eventually produced significant gains. This doesn't mean an immediate explosive rally is guaranteed. It means the conditions that have historically preceded major moves are developing. The timing remains uncertain. The framework suggests this crash could indeed be setting up a significant move. Whether that move comes quickly like 2020 or slowly like post-2013 depends largely on how monetary conditions evolve. Let me address the counter-arguments. The bull market in gold and silver is over. This crash marks the top. For this to be true, the fundamental drivers would need to have resolved. Government debt would need to be declining. Central banks would need to have stopped printing money permanently. Inflation would need to be truly vanquished. Currency debasement concerns would need to have evaporated. None of that has happened. Debt levels continue rising. Central banks have demonstrated they'll print during any crisis. The structural drivers remain. Every previous "the bull market is over" call during a crash was wrong. That doesn't mean this one is wrong. But history suggests caution with such calls. Interest rates will stay high forever. Gold can't rally. Interest rate cycles turn. They always have. The highest rates in history eventually declined. The longest tightening cycles eventually ended. Current debt levels make sustained high rates mathematically challenging. The interest expense on government debt is already exceeding defense spending. Something will give. This crash was different. The technical damage was severe. Technical damage was severe in 2008, in 2013, in 2020. Charts looked terrible at every crash bottom. That's what crash bottoms look like. Technical damage is a feature of crashes, not evidence that recovery is impossible. Cryptocurrency has replaced gold. Younger investors don't care about metals. Central banks aren't buying Bitcoin for their reserves. They're buying gold at record pace. Generational preferences for speculation don't eliminate institutional demand for proven monetary assets. So what do you actually do with this information? First, monitor the 4 conditions. Watch the COT data for positioning. Follow central bank purchasing reports. Track monetary policy developments. When all 4 conditions align strongly, probability favors significant moves. Second, consider staged accumulation rather than all-at-once buying. Crashes can extend further than expected. Bottoms are only certain in hindsight. Buying in tranches reduces timing risk. Third, match your time horizon to your strategy. If you're accumulating physical metal for long-term wealth preservation, short-term price action is noise. If you're trading, shorter time frames require different approaches. Fourth, understand the difference between physical and paper. Physical metal has no counterparty risk but less liquidity. Paper products offer liquidity but carry counterparty and contango risks. Know what you own and why. Fifth, prepare for multiple scenarios. What's your plan if prices continue falling? What's your plan if a rally begins? Having predetermined responses prevents emotional decision-making. Sixth, recognize that patience may be required. The 2013 crash took years to fully recover. If current conditions more closely resemble 2013 than 2020, the setup may take time to develop. This isn't failure. It's how markets sometimes work. This is the silent economy. Here's what we know. Every major precious metals rally in modern history was preceded by a crash. The pattern is consistent. The setup is mechanical. The opportunity exists in the wreckage if you have the framework to recognize it. Here's what we don't know: exactly when the next major move will begin, whether it will be swift like 2020 or slow like post-2013, how low prices might go before the turn. Here's what you now have: a framework for understanding post-crash behavior, 4 conditions to monitor, historical context that most investors never study, an advantage. The crash happened. It may or may not be complete, but the conditions that have historically preceded major moves are developing. If this analysis was valuable, subscribe and hit the notification bell. Next week, we're breaking down exactly what central banks see in gold that's driving their record accumulation and what it signals about the future of the global monetary system. Drop a comment below. Tell me how you're positioned. Are you buying this dip or waiting for further clarity? I read every comment. Markets reward those who understand patterns, who study history, who maintain rationality when others panic. That's the edge. Thanks for watching. This is The Silent Economy, and we'll see you in the next one.